You probably think the money you deposit into your checking account sits idly in a dark vault, waiting for you to come back and claim it. In reality, the moment you hand it over, it is fed directly into an incredibly complex, constantly moving machine. At the very top of this machine are central banks, like the US Federal Reserve. They do not hold your personal checking account. Instead, they act as the puppet masters of the entire economy, creating money out of thin air and setting the rules for everyone else. They dictate the speed of the economy using monetary policy. If commerce is moving too slowly, they flood the system with cash, either by printing it directly or by cutting interest rates, which makes borrowing money much cheaper. Cheap loans lead to higher wages and expanding businesses. Politicians routinely pressure central bankers to keep rates low because a booming economy looks great on a campaign poster. However, pumping too much cash into the system causes prices to skyrocket, triggering runaway inflation. Central banks rarely interact with the general public. Their specific role is to set the macroeconomic weather, the baseline amount of money and demand for the organizations that actually handle your cash. That brings us to the workhorses, commercial banks. These are the places where your paycheck actually lands. They sit right in the middle, taking idle cash from everyday savers and funneling it over to people and businesses who need to borrow it. Banks do not keep your full deposit on hand. Through a mechanism called fractional reserve lending, they are legally permitted to lend out money they do not actually have. In many major economies today, their required reserve rate is effectively 0%. When a commercial bank issues a new loan, they are creating new money. By transforming a single deposit into multiple layers of debt, they are rapidly expanding the global money supply far beyond the cash the central bank originally printed. Your checking account is a highly active fuel pump, constantly injecting capital into the riskier, higher stakes tiers of the global financial system. Before your paycheck even clears that commercial bank, a chunk of it is usually siphoned off into the hands of the true titans of global finance, pension funds. Pension funds control over $60 trillion worldwide. To ensure retirees actually get paid decades down the line, they need a steady 6 to 7% return. They achieve this by buying up massive tangible assets like major landmarks, skyscrapers, and luxury resorts. For money outside of retirement, ordinary people use mutual funds. These institutions pool smaller amounts of money from regular investors to buy massive, professionally managed baskets of stocks and bonds, offering instant diversification without requiring $1 million buy-in. Then we have insurance companies. They operate as the world's ultimate risk spreaders, collecting millions of small monthly premiums from people protecting their cars, homes, or health. Because disasters rarely strike everyone at exactly the same time, insurers accumulate gigantic, highly predictable reserves of cash. Together, these three entities hold the vast majority of the public's wealth, but they are bulky organizations managing too much money to execute aggressive, high-return strategies on their own. They require middlemen to deploy their capital. Enter the investment banks. These are the corporate matchmakers of Wall Street. Their sole purpose is to connect those massive, passive pools of institutional capital with businesses desperate for cash. They move billions of dollars through three primary mechanisms: orchestrating initial public offerings to sell private company shares to the public, structuring massive corporate debt loans, and guiding companies through complicated mergers and acquisitions. The defining skill of an investment bank is utilizing armies of lawyers and analysts to hype up deals, ultimately convincing the pension funds and insurers to hand over their cash. Without these bankers actively cutting deals, the public savings would never cross over into the high-stakes playgrounds of the financial apex predators. Those playgrounds belong to hedge funds. These are exclusive, largely deregulated pools of money, entirely restricted to the ultra-rich and major institutions. They use massive amounts of borrowed money to place aggressive bets on anything they can, including crashing stocks, shifting oil prices, and global disasters. Operating right alongside them is private equity. They act as corporate house flippers. They raise billions to buy legacy businesses, a fraction of their own money, and aggressively borrows the rest. Once they secure control, they shift the loan off their books, dumping the debt entirely onto the acquired company. If restructuring fails, the target company holds crushing interest payments, while the private equity firm remains safely isolated. We see the direct consequence in the real world. Brands like Toys R Us were loaded with $5 billion in private equity debt, bled dry by the massive interest payments, and ultimately forced into bankruptcy and total liquidation. When these gambles collapse, the private equity executives keep their management fees. The massive financial losses are fully absorbed by the original capital providers, meaning the public's pension and insurance funds take the hit. At the absolute peak of the risk pyramid is venture capital. Instead of buying established companies, VC firms take institutional money and spray it across hundreds of unproven, high-risk tech startups. They operate entirely on the power law. VCs mathematically anticipate that 90% of their startups will fail to return a profit. They are relying entirely on the 2 or 3 astronomical successes to pay for the failures of the entire portfolio. In 2004, Peter Thiel's Founders Fund wrote a $500,000 check to a tiny social network called Facebook. Most of his other investments that year went nowhere, but by the time Facebook went public, that single check had multiplied into over $1 billion. When you zoom out, you realize every single one of these hyper-specialized organizations relies entirely on the exact same base layer of capital to function. Your biweekly paycheck, your mortgage loan, and your monthly insurance premiums are actively recycled and weaponized across global markets. You are the lifeblood of this invisible, unstoppable wealth-generating machine. If you want to understand exactly how the money in your pocket operates behind closed doors, make sure to like and subscribe.